You're watching Indian Open. We are stepping away from the markets and moving into the space of deals, deal making, asset management and structured credit. That's the suite that Avendus now offers with deal making actually now about half of their business. So they've got a lot going on. Ranu Vohra is here with us in the studio. Ranu, it's an absolute pleasure to have you here. Thanks so much for stopping by.
Thank you for calling me.
We've got a whole bunch to talk about and we'll get into each of your individual businesses. But, given that you've got so many businesses, you know what the pulse is looking like right now. How are we stepping into 2018, confidence-wise, confidence for entrepreneurs, deal makers, financiers? What is it looking like?
I think India is looking quite strong. I think we are already seeing on the ground good level of momentum. We are seeing investments come into the system. And we are seeing good visibility on earnings. So I think our view is the next 3 years, you should see a 15% odd earnings growth in this country. We're also seeing a very interesting move towards good governance. So as these mid-sized companies grow, or some of them go public, we see a very strong movement towards good governance. So all these are very positive, kind of trends for this year. We also see a lot of capital which is now getting ready for India, what we call dry powder. So there's a lot of dry powder which is waiting to get into deals. I think what I am worried about, two things I'm worried about, is that the market doesn't factor in risks. And I think the global risks are just, kind of just building up. And we don't know what part of the risk could come in at what point of time and spoil the party. But that is something which is a worry to me. But fundamentally, with whatever's happened with demonetization, with GST coming in smoothly, I think there is, in my mind, good visibility and track for Indian corporates.
Ranu, you managed to sort of catch the upcycle in terms of the equity investing culture through your, asset management piece, your hedge fund in particular. What's your sense? This is a lasting phase where, just general interest in equities is increasing. Willingness to go towards, more than pure equities, perhaps look at interesting strategies, the kinds that your hedge funds offer, is there? It'll sustain?
If you ask me, I think India has traditionally been very, very, very low on equities. And even if I look today, about 1.5% of assets are sitting in equities. A lot of other things were happening in this country. People were substituting that risk, which they would have got through equity, by way of real estate, for instance. People were investing in real estate. And a lot of those investments are now trying to get back to the equities universe. So when you look at equities, while the traditional retail investor would look at a mutual fund, a lot of the larger families, even the mid-sized families, are considering alternate strategies, different ways of investing in equities, different, risk-return profiles. And I think that is going to lead to, in my mind, an explosion of alternate products, which will cover the entire risk-return map. And you can virtually look at that curve and say, there is something missing here, let's bring out a product in this area or the other area. So you will find a lot of products coming up and families getting in. So whatever we saw, for instance, our hedge fund business is today about $1.4 billion. My sense is, I wouldn't be surprised if in the next 3 to 5 years, this is not a 1, 2x, but probably an 8, 10x kind of an increase. So there is a lot of appetite, and I say that because there's a lot of headroom available in the market.
This is coming from where? Family offices, HNIs, entrepreneurs who are the nouveau riche. Where is this coming from?
It's coming from, right now, a lot of it comes from family offices and HNIs. I think they are the first adopters of these products. They have taken the pains to build family offices, meet distributors, develop knowledge around these products. I think the real institutional market, when I look at our insurance companies or banks, I think that has been very, very slow. So the next phase of growth, if you might, after this first wave, will come from these institutions. But right now, it's just domestic wealth, which is getting, I would say, which is coming towards risk. We met an interesting family which manages about 1,000 crores plus. And they had virtually like less than 1% allocation to equities. Whereas in any other country, I would not be surprised if that number was 25%. So that's the kind of headroom we are talking about.
Interesting. And for you, how large is that business, and where do you see it go as a proportion of your overall pie, the asset management business?
Yeah, and can I tack on a question to that? I think it'd be nice if you could describe to us your total size of business. Given that you grew from a traditional investment bank to now, like Kira pointed out, a suite of different products, whether it is wealth management, asset management, the credit business, or investment banking. What's the total size of the business right now? Whatever numbers you can share with us. I know you're privately held.
Sure.
Just to give us a sense of what the growth's been like in these spaces.
Sure. So to give you a sense, we have 4 businesses. We started with a traditional investment banking business, which continues to be very strong. And that's on the back of the growth in digital and technology and consumer. The 2 verticals which have fired it, and now healthcare, IT are coming back. So the deal making in that is, and the fact that the yields or fees in investment banking are well protected is helping us build that business. We built a wealth management, alternative asset management, and credit business on top.
Right.
Because what investment banking gave us initially was a good bunch of entrepreneurs who we could back. As the economy goes from 2.2 trillion to, let's say, $4 trillion over the next 8 years, our views is that the new market cap addition, new GDP addition, a lot of that will come from newer companies, newer business models, digital. Digital could be as much as 20% of the total GDP in 10 years from now. So these are the models we are backing, and these entrepreneurs are getting richer. They are getting value. So we built a wealth management business on top. We built an asset management business because we could get very high quality talent. What's the difference between the two?
Aren't they the same? Wealth management and asset management?
Wealth management in our minds is where you look at overall asset allocation for a family.
Okay.
And those assets could be allocated depending on their liquidity
needs. So
it's
more advisory than anything else.
Yes,
okay,
it's advisory led, and you're more like a third party architecture. That's the model we followed, where we put best in class products to the HNI families. But what asset management is more pieces, products where one, obviously value can be created, and second is you can build scale. So each of our asset management products, our idea is we should get them to $500 million or higher for it to qualify in our stable as a product.
And can you share with us the group numbers at all? I mean, as in the group of businesses, not the group, but what all of this is, amounting to, either from a top line or net worth point of view, or something to give us a sense of?
Well, I can certainly share the net worth with you. We're getting close to 1,000 crores this year in terms of net worth. And the numbers on the top line this year should be in excess of 300 crores. Okay. Hopefully the story gets even better next year.
And your credit business, how big is the book?
Right now, we have infused about 500 crores in the credit business, which has been funded by the investment we took on board from KKR, and then from KKR and Gaja Capital. The idea is to build a book of about 3,000 crores in the next 3 years.
3,000 crores in the next 3 years?
Yes.
And this is what? Credit to small and medium-sized enterprises, structured credit of sorts, right?
Yes. This would be, as I like to call, flexible capital available to entrepreneurs. As these companies follow new business models, they're not very asset heavy. We are living in a very different world where assets are not necessarily perceived as the best thing to have. The Airbnb is being a classical example, but a lot of traditional businesses also do not want assets or asset heavy businesses, which means your sources of finance when you go to a bank are constrained, and you have to rely on alternate structures for you to raise capital. That's where we're very good at. We're very good at understanding the solution which this mid-sized growing company would need to meet its objectives.
Highly competitive space, isn't it?
Not actually, because
not this mid-sized space.
Actually it's not competitive because, at least for now, the reason is that these are not traditional, cookie cutter kind of products. Right? This is not a product you would just take and say this is a loan against shares or this is a loan against property and go to a bank or an NBFC and get that money. This involves virtually a creation of a deal. Right? You go through the cash flows, you go through what acquisitions the entrepreneur is doing, you go through his cap structure, and then come back and say these are the changes we would like to make for your long-term sustained growth. Maybe you can pick up equity capital in 2 years from now. Right now, you virtually sit down and make a solution.
Right.
And that, given our investment banking DNA, we can kind of put together very well and bring that out.
How would you characterize the health of these medium-sized enterprises, Ranu? Because it seems to have been a fairly choppy year and a half. I don't know how many of the size of enterprises that you work with were, deeply impacted by demon, but I'm sure GST has had a big impact on them. Today, when you look at the sector, would you say that it's sort of recovering? Is it growing back to growth, or is it still sort of finding its feet?
I would say that effectively after September of last year, the kind of companies we are backing are companies which have, in that manner, are largely in the organized sector. They're competing with the unorganized sector. They're competing with the sector which had some advantages because they didn't have to pay GST or they were following other modes. But now, given GST and the beneficial effects of that, these companies, same companies are winning market share. Right? They are growing. They have more visibility on their earnings. Their models are being better appreciated, and all along the value chain, you can kind of, it's become a very transparent system. So with GST, the sources of capital available for these companies, their growth, all of that has been impacted positively, and that's what traditional investors look for. They look for what is the visibility on your earnings and how your growth is. So it has benefited positively. As I said, there was a period sometime between July and September when there was more noise, but post September it's been good. It's been very good, and we can see the growth on the ground.
Okay. Ranu, if I may, I heard you mention somewhere that the kind of businesses that you are backing are asset light, a lot of them in the digital space as well. I just wanted to understand from you as to where is it that you see the biggest bang for the buck in backing businesses, and where you believe the market will eventually see that coming around as well. Listed or unlisted doesn't really matter. What theme, what space?
So we are looking at several themes. I would say we are looking at industry disruptors. That's a very big theme for us. There are industries like logistics, industries like financial services, where there is disruption, which is very imminent. So we are looking at even younger firms which are propagating that. We are looking at areas like consumer. India has, there has always been a question, but we can't deny the fact that there's a sizable middle class, which is now, in some manner, has access to internet and a smartphone.
Sure.
And there are, the next generation might not want to go to a mall in the first place, right? They would just shop on a cell phone and get what they want to. Yeah. So there is a new consumption trend, and that consumption, will increase. There are new products which will emerge on the horizon, and those products will be sold differently from the way traditional FMCG products have been sold.
So not necessarily manufacturers, but enablers of sorts in the consumption pocket, if I may.
Yes, we are seeing more of companies which are bringing out brands. Manufacturing is still, in our minds, the innovation in manufacturing is happening at a slower pace. I would say that it still needs a push.
Okay. What about logistics? Because that's a direct play via GST as well. Having spoken to a few listed players in the recent past, they are saying that while there are some teething problems, they are hopeful of all of these moving away only after maybe another 12 odd months. So in the near term, there might be a lot of disruption. Eventually, it might benefit, but we are not seeing any tangible benefits, at least in terms of the numbers coming in from the listed space. When you talk about logistics, what do you mean? What is it that you're backing, essentially?
So I think logistics, in my mind, there are several ways of enabling a solution to an auto manufacturer who wants to send out its cars, in a certain way. Whether it comes to warehousing and warehousing-led solutions, to the whole logistics, the whole value chain of the logistics, whether it is the trucking part of it, whether it is in some manner the railway part of it. So there is the disruption in all of this is led by technology. One has heard of companies like Revigo, for instance, doing some good work in disrupting the whole trucking value chain, right? So there are companies like that which are coming in and which are just fundamentally changing that. And the assumption underlying all of these is that technology solutions are going to guide logistics, right from, basically every product which is coming out of the shop has a little bit of a stamp on it, and that is just enabling you to do what you have to do.
Two spaces, consumer technology and financial technology. So on the consumer tech space, what is 2018 looking like? Some consolidation happened. Do you see that continuing? Are these companies being able to reduce burn, become a little bit more sort of feasible financially? What's happening in that consumer tech space?
So I think a lot of the market and our assessment of the health comes from horizontals, right? Where the large horizontal e-commerce kind of plays. But the market has gotten deeper than that. There are verticals now. There are, for instance, verticals like eyewear, which are becoming large, right? There are, there are the jockey equivalents in the innerwear space, right? So all of those models are becoming very interesting models. Those are models where the focus has moved from just sheer growth and just being a kind of an all brand shop to creating their own brands. So the first move happened about a year and a half, 2 years back, when these companies started moving towards their own brands, right? So Zivame would try and get its own brands, others would. So that was the first move which happened. And now the move is also to capture a bit of offline. So, interestingly in India, offline can give you access to areas, to opportunities. And while traditional digital internationally doesn't account for that, India is a very local market, where sometimes the look, feel is very important of a store and a shop. So you find a lot of these players going in the consumer area, building offline to also improve their unit economics. So I think there is a move towards own brands, better unit economics.
Traditional business in some ways, right?
It's, I'm actually kind of, as I look out, I'm not sure after 5 to 10 years, traditional businesses will look like digital or digital will look like. So it's a world where they're just constantly kind of coming towards each other at a very fast pace. How that collision happens, I don't know.
Okay. Okay. And in fintech, beyond payments, has anything emerged to a point where, I don't know if you're funding or banking any of these fintech spaces, but it seems like it's all come back to payments, right? Beyond that, the SME platforms and all, they're doing something, but not a huge amount.
Well, I think there are models emerging. Well, payments is obviously one area.
Yeah,
and as I said, it's a more visible kind of area, but there is lending in a very large way.
The SME
lending, inclusion. So just the whole concept of financial inclusion and how you can use technology to kind of create that. So I think both are models which are in some manner. Then there's a whole concept of credit analytics.
Yeah,
right?
that's
how can you actually, sitting here, depending on how you paid your electricity bills over the last 15 years, who are your Facebook friends, how many of them are defaulters and how many are kind of regular payers. So there is so much of analytics available. So there is a move towards analytics and data to define who you are as a person. And the score that gives is in some manner very different. And similarly, there is going to be a use of AI based, systems, companies, which will in some manner determine. So again, it is a huge change in financial services where I'm unable to see how banks will cope up unless they kind of also very soon start looking at.
But there's investment money chasing these kind of platforms, investment money or traditional banks looking to invest in any of these, credit analytics or SME platforms.
Yes, I think there is the good news is that there is capital. The not so good news is that this capital dries up very quickly as the company grows. And it's very easy to find a bunch of angels to give you the first $2 million, $3 million, and then starts an uphill battle. The next 10 million is difficult, the next 25 is difficult. And then, believe it or not, 50 to 100 becomes easier. So I think it's that hump you have to kind of go from that Series A to maybe a Series C, which is a very difficult hump. But there is capital available, and banks have also been toying around with, how do they make investments in fintech.
Why have you stayed away from the ARC stressed asset space? I mean, deal making is something that you built this business around, right? And that seems to be the hottest space. I understand that the ticket sizes of some of those assets currently in insolvency or resolution are much larger than the traditional deals you do. But there are several small companies now in the space, right?
So I think, the way I would like to answer that question is the space is attractive. However, we have a few things with us at the moment on our plate, which actually require that time and attention, whether it is our hedge fund business or whether it is
So it's
doing
more
other
internal
pieces.
reasons or reasons to do with the, the risks you see in the ARC business or the risks you see in the restructuring M&A deal business that has kept you away?
I think there obviously we have, the insolvency law is making life easier and more transparent for bidders. However, the story is yet to play out. We are hoping it will play out well, but the number of variables there are way too many. And we think that, an investment in that space versus an investment in pure growth space, we are able to generate equal or better returns in the growth space. So which is why purely from a priority perspective, I'm not saying it's not a space to back, but purely from a priority perspective, it is higher priority for us to go after growth, go after areas like digital and disruption rather than actually an ARC or distress. Having said that, maybe a year later we talk and things have changed.
Maybe it's also a high capital business, right? You need to raise lots more money, which you probably are currently putting into your credit business. I just am assuming.
Yes, I mean, again, the way India is growing, the way our business lines are growing, there is, as you can expect, these businesses need that fuel to grow and need that capital. And capital comes at a price and is scarce. So we are conscious about what our priorities should be in a market like this. And can we do everything together or can we do only a few things well?
Sorry, Ira.
Yeah, no, you would have some play in the stressed asset segment, not in these large cases, but via your structured credit, because a lot of the structured credit customers are also special situation customers, right?
They're special situation, but not necessarily stressed or distressed.
But one level below that, where they have issues, ranging pure bank funding or pure bond funding.
Yes, if you extend the definition to that, yes. Then technically a lot of them are folks who might not find conventional financing for that particular product, and we are able to offer them that. I think you touched on an important point, and I think we do come across in that area. There is a bit of overlap between stress and credit to some extent. And if you find the right entrepreneur who for whatever reason has great industry, sometimes people tend to over leverage financially. So those are cases which we are able to, where the only issue is the financial structure.
Structuring.
Those are issues which you can sort out. But if it's an industry-wide problem or a commodity where you're taking a bet that the commodity prices will rise, those are not the bets for us.
Sure.
Okay, I have a couple of questions. I don't know if Neeraj has any, but two. One is, leave us with some trends that you think will dominate 2018. In a recent interview, you were suggesting that you were going to stay away from real estate and commodities when it comes to, I think, some parts of your investment business. Are they continued stressed areas that you see? Or it might be some trends or great companies or great ideas that you're seeing play out in the private equity or more traditional investment spaces. What do you think 2018 will be about?
I think 2018 will again be about there are some traditional sectors which I think will obviously kind of find the uplift coming because of the economy improvement and the earnings improvement. I think what we are very excited about is the chain around, as I said, around the consumption market.
Okay.
And everything around the consumption market, whether it is digital or offline. We still think that that's a good area to back in this year. We will be constantly watching for another trend, and that trend is where the generational change is happening in companies. And we realize that some of the companies, actually some of the best performers in terms of value, are companies where there is a generational change, where the patriarch of the family has found this 35-year-old and rediscovered his 35-year-old son who has a very different view on how to build the business. And so we are finding a lot of, and by the way, a lot of companies in India, most companies in India, well, I mean, it's hard to kind of put names there, but you have to look like businesses like Kajaria, you have to look at businesses like iShare, you have to look at how the next generation has taken over and created significant value. So I think it's about that. It's about how those changes will continue to happen in India. Corporate India and family businesses will change in dimension. That's something which I'm very deeply interested in, and I continue to kind of engage with entrepreneurs there. The other thing is purely inbound M&A driven, where we think that inbound M&A in India has been just increased, but marginally last year. And our sense is that today, sitting in boardrooms in Europe and US, there is a very large demand for India coming back to the boardrooms, where companies, whether it is in pharmaceuticals or companies in traditional consumer or even retail, are going to look at companies in India and healthcare and look at acquisitions in India. So I think that could be a theme. But the overriding theme in all of this is domestic economy fueled, domestic economy and domestic investment fueled theme.
Okay. I have a 30-second last question. Why did you give up control?
I think for us, it's the key part was how do we build this organization, and as we built the organization, one of the things we agreed to with KKR was that we would continue to build it as a platform. So while KKR is a large shareholder, in excess of 60% shareholding is with KKR, we are building the platform here, and there is as we discussed, there's a lot of headroom to grow, and a lot of the solutions we look for our clients require a balance sheet. So when you go along that route, you have no option but to take good investors with you who are long-term and who can help you go in that journey. And we found a good meeting of minds with KKR. So in my mind, we continue to work twice as hard. We continue to run. Obviously, KKR is a large shareholder, and they put in their best to help us out with some of these situations.
Okay, great. I'm sure at some point they will start talking an exit, and then we'll be talking to you about an IPO. I know offline you told us it's not imminent at any point in time, so maybe a few years down the line. But Ranu, Neeraj, do you have any last questions?
No, I think we're out of time as well. So
okay, great. Ranu, thank you so much for joining us here on Bloomberg Queen. Always interesting to speak with you and look at the market through your eyes. So thanks very much for that.
Sure. Thank you for having me over.
Yeah, and that brings us to the end of today's show, though. Stay tuned, because the FNO show will take forward the action on the other side. Keep in mind, IT is the buzzword for today's session.